macro currency signals.
You feel it before you can explain it. The quiet tension, the kind that builds in a market long before the headlines arrive. Silver does not move like gold. It does not drift upward in polite increments. It compresses, it coils, it disappears into boredom. And then, when the pressure underneath the surface becomes too much, it does something violent. Right now, we are not watching a speculative frenzy. We are watching a structural shift. For years, most investors in the West looked at silver through a very narrow lens. Futures charts, options flows, commitment of traders' reports, exchange inventories, the daily noise. The price became something that flickered on a screen, detached from where the metal was actually moving. But the physical world never stopped moving. And over the last 2 decades, something far larger than retail enthusiasm has been unfolding, quietly, methodically, strategically. Silver has been flowing east. Not because it was fashionable, not because it was trending on social media, but because it was being absorbed, refined, accumulated, retained. To understand why the present moment feels different, you have to understand the plumbing. Most silver is not mined as silver. Before we dive deeper, if this analysis is hitting the way it should, make sure you're subscribed and have alerts turned on. In shifts like this, being early isn't optional. It's everything. Jump into the comments and let me know where you're watching from and what time it is where you are. This isn't a local discussion, it's global. And seeing how far this message travels always says more than any headline ever could. All right, now let's get back to what just unfolded. Roughly 60% of global supply comes as a byproduct of copper, lead, zinc, and other base metals. That means silver production is not simply a function of silver prices. It depends on the economics of entirely different industries. If copper production slows, silver supply slows, even if silver demand is rising. Now think about processing. Refining silver at scale is not clean, it is not politically attractive, it is energy intensive, chemically heavy, environmentally controversial. Over time, much of that refining capacity migrated to Asia. Large volumes of partially refined metal, ore, have historically been shipped there for final processing. And once processed, a meaningful portion did not return. It stayed, accumulated within domestic supply chains, absorbed into vaults, fed into industry. The result is a structural asymmetry. Western markets trade enormous volumes of paper silver, futures contracts, forwards, swaps. The daily notional turnover dwarfs physical movement. That system functions smoothly when physical supply remains elastic, when the underlying metal can be sourced without friction, but what happens when the metal becomes strategically important? Because something changed over the past decade. Silver stopped being just a monetary hedge. It became an industrial necessity. Solar panels require silver, not a token amount, a real, measurable, unavoidable quantity. Every expansion in photovoltaic manufacturing increases baseline silver consumption. Electric vehicles compound that effect. Advanced electronics, high-efficiency circuits, charging infrastructure, data centers, artificial intelligence infrastructure, grid modernization. The digital world is not weightless. It is built on conductive metals, and silver is the most conductive metal on Earth. Now overlay that industrial acceleration with strategic accumulation in Asia, and something begins to tighten. It does not show up immediately in price. It shows up in flows, in export patterns, in refinery throughput, in subtle changes in lease rates and forward spreads. In the ratio between open interest and deliverable inventory, the market looks calm on the surface. But beneath that surface, the buffer is shrinking. There is a phrase that confuses many people. There is no silver. It does not mean silver has vanished. It means that at a given price, freely available, investment-grade, deliverable silver in Western vaults may be far thinner than most assume. Derivative markets create an illusion of abundance. Contracts can be written in enormous multiples of underlying physical stock. As long as only a small percentage ever stands for delivery, the system operates. But if industrial users, sovereign actors, or institutional investors decide to increase physical allocation, even modestly, the ratio tightens quickly. This is where psychology begins to shift. In a loose market, rising prices attract sellers. Producers hedge, investors take profits, supply meets demand. In a tight market, rising prices can reduce willingness to sell. Holders hesitate, industrial users stockpile, long-term contracts replace spot exposure. A feedback loop develops. Economists call this a Giffen-like behavior. When price rises, demand does not immediately collapse, because the metal is not discretionary. Solar manufacturers cannot simply switch to plastic. Grid operators cannot substitute aluminum in high-precision circuitry without consequence. And if investors believe that rising prices signal structural scarcity rather than speculation, they do not rush to sell. They accumulate. Now imagine this dynamic layered onto a derivative market historically accustomed to abundant physical flow. Paper pricing has long dominated silver. Price discovery happens in New York and London. Contracts roll, positions offset. Cash settlement remains the norm. But paper pricing ultimately depends on confidence that physical supply exists behind the screen. Not infinite supply, sufficient supply. If that confidence begins to erode, not collapse, not panic, just erode, the volatility profile changes. We have seen this movie before in different forms. When leverage meets tight inventory, price does not adjust politely, it gaps. And here's the part many miss. The current environment does not resemble prior speculative blow-offs. In past silver spikes, speculative participation was obvious. Leverage was extreme. Momentum funds crowded the long side. When price reversed, liquidation was brutal. Today, speculative enthusiasm remains muted relative to historic manias. That is not bearish, it is structurally explosive. Because if price begins to move due to physical tightness rather than speculative froth, momentum money eventually follows strength, not before it, which means paper demand can stack on top of already constrained physical supply. That is when volatility stops being theoretical. Now consider the monetary layer. For centuries, silver functioned as money across vast regions of Asia, not as a hedge, not as a trade, as money. Modern fiat systems suppress that memory, but cultural memory does not evaporate. Gold has clearly reemerged as a strategic reserve asset in recent years. Central banks have been net buyers at historic pace. Sovereign diversification away from exclusive dollar exposure is no longer fringe theory. Silver occupies a different category. Smaller market, lower total value, but dual use, industrial and monetary. That dual identity makes it uniquely sensitive to systemic shifts. If a region prioritizes industrial self-sufficiency and strategic reserve diversification simultaneously, retaining silver internally becomes logical. Export revenue matters, but control matters more. Now let's talk about price. The number itself, whether 50, 100, 300, or something far more dramatic, is not the starting point. The starting point is the imbalance. Price is the release valve. In a stable system, price moves gradually to ration demand and incentivize supply. In a leverage system with thin buffers, price sometimes overshoots violently before stabilizing. Is a 4-digit silver price a base case? No. Is it mathematically impossible? Also, no. Extreme price spikes in thin markets do not require infinite demand. They require temporary dislocation between paper promises and physical availability. If a short squeeze intersects with industrial stockpiling and sovereign accumulation during a period of currency instability, prices can overshoot far beyond long-term equilibrium. But overshoot is not the same as permanence. And this is where discipline matters. Silver at $1,000 would not represent calm equilibrium. It would represent stress. It would signal something broken in monetary confidence, supply chains, or derivative structure. It would not be a normal bull market milestone. It would be a warning flare. The real question is not whether silver can spike, it has. The real question is whether the structural forces now in motion are stronger, broader, and more systemic than in previous cycles. Industrial demand is structurally higher. Energy transition policy is politically entrenched. Geopolitical fragmentation is intensifying. Central bank trust in fiat exclusivity is softening. Derivative leverage remains high relative to physical stock. These are not internet rumors. They are observable trends. Now ask yourself this. If physical silver becomes strategically hoarded rather than freely exported, if industrial demand continues rising regardless of short-term price, if speculative money eventually chases momentum instead of initiating it, if currency volatility accelerates capital rotation into hard assets, what happens to a market this small? Because silver's total market value is tiny relative to global financial assets. A modest reallocation of institutional capital can overwhelm available float. That is not hype. That is arithmetic, and arithmetic in tight markets can become dramatic. The reason the present moment feels urgent to some is not because of a calendar date. It is because structural forces take years to build and then release in months. When release begins, access changes quickly. Premiums widen. Availability tightens. Delivery times extend. And price, which looked boring for years, begins to move in ways that feel surreal. But here is the critical discipline. Structural tightness does not eliminate volatility. Silver is notorious for violent corrections even within bull markets. A squeeze can reverse sharply if liquidity injections, regulatory adjustments, or demand pauses intervene. Believing in a structural case does not mean abandoning risk management. It means understanding the asymmetry. If downside is bounded by production cost plus industrial baseline demand, and upside is theoretically unbounded in a squeeze, the payoff profile becomes skewed. Skew attracts capital. Capital accelerates moves. Moves attract narrative. Narrative attracts late entrants. And then the cycle tests conviction. We are not at the mania stage. We are at the compression stage, the quiet stage, the stage where few are paying attention. And those who are paying attention are not shouting. They are calculating. Whether silver reaches 3 digits, 4 digits, or stalls well below depends on variables no single participant controls: policy decisions, export flows, energy prices, currency stability, industrial substitution, innovation. But what is increasingly difficult to dismiss is that the old assumption, endless cheap silver flowing westward into deep liquid derivative markets, may no longer be safe. If that assumption breaks, even partially, the repricing does not have to be linear. It can be abrupt. And when repricing begins in markets this small, it rarely gives polite warning. This is not about panic, it is about preparedness, because if a shock comes, it will not arrive with consensus approval. It will arrive while most are still debating whether it is real. And by the time consensus forms, price will already be somewhere very different from where it was when nobody cared. That is the nature of tight markets. That is the nature of silver. Now let's go deeper, because compression by itself does not create a price shock. Compression needs a trigger, and triggers rarely look dramatic at first. They look like small adjustments: a refinery delay, a modest export restriction, a change in industrial procurement policy, a quiet surge in long-term offtake agreements. Nothing that screams crisis. Until the cumulative effect reaches a tipping point. Here's the uncomfortable truth about silver. It is a small market sitting inside a massive global financial system. The total above-ground investable silver supply is tiny compared to the scale of sovereign wealth funds, pension funds, insurance pools, and institutional capital. Even a fractional shift in asset allocation toward physical metal can overwhelm available float, not because silver is rare in the Earth's crust, but because readily deliverable, investment-grade silver at current price levels is limited relative to potential demand. And this is where the shock pathway begins. Imagine the following sequence. Industrial users, already concerned about long-term supply, begin increasing strategic inventories. Not aggressively, just prudently, extending procurement from 3 months to 6 months, from 6 to 9. That incremental buying does not spike the price immediately. It quietly tightens availability. At the same time, a currency tremor develops, not a collapse. Just a visible acceleration in loss of purchasing power across major economies. Bond markets wobble. Yields behave unpredictably. Large holders of sovereign debt begin reallocating reserves toward tangible assets. Gold reacts first. Gold always reacts first. But gold is deep, liquid, and heavily capitalized. It absorbs flows more smoothly. Silver, on the other hand, is volatile by nature. As gold strengthens, the gold-to-silver ratio begins to compress. Historically, extreme compression phases have preceded aggressive silver outperformance. Investors watching relative value metrics begin shifting capital from gold into silver. Now you have 3 concurrent forces: industrial accumulation, monetary rotation, relative value rebalancing, still manageable, still orderly, until something mechanical changes in the derivative structure. Futures markets function on confidence that most contracts will never demand delivery. They are financial instruments, not warehousing systems. But if rising prices and tightening physical supply cause a modest increase in delivery requests over consecutive contract months, inventory buffers shrink faster than expected. Lease rates rise, backwardation appears intermittently, forward curves distort. Bullion desks begin quietly sourcing metal at premiums. These are not headlines, these are whispers. But sophisticated participants hear whispers before the public hears noise. Now consider behavioral feedback. In loose markets, price rallies attract sellers. In tight markets, rallies create fear of being unable to replace inventory. Industrial users hesitate to sell surplus. Investors hesitate to take profit. Producers hesitate to forward hedge aggressively. Liquidity dries up on the offer side. Volatility expands. Momentum funds, which had been absent, now detect sustained upside. Algorithms do not care about narratives. They respond to trend strength and volatility expansion. Once technical thresholds are breached, systematic capital joins the move. Paper demand stacks onto physical tightness, and the repricing accelerates. At this stage, media attention begins. Headlines shift from steady gains to unusual surge. Retail awareness follows. Premiums widen in physical markets. Delivery times extend. Small bars disappear first, then larger formats tighten. This is not yet a collapse. It is a strain. Now introduce geopolitical friction. Trade blocs harden. Strategic materials are categorized as critical resources. Export licensing becomes more restrictive. Domestic industries are prioritized. If a major refining hub reduces outbound shipments, even modestly, the impact on Western exchanges can be disproportionate. Because the system was calibrated for steady inflow. Remove the inflow and the derivative structure must adjust. Adjustment rarely happens calmly in leveraged systems. Margins increase, position limits are reconsidered. Volatility spikes intraday. Traders accustomed to narrow ranges are forced to deleverage. Short covering becomes reflexive rather than strategic. Each upward spike feeds further covering. Each covering wave lifts price beyond where fundamentals alone might have placed it. And here is where the idea of extreme price prints enters the conversation. not as a base case, but as a possibility in stress conditions. A 4-digit silver price would not emerge from normal economic growth. It would likely require a confluence: severe currency instability or rapid devaluation in one or more major economies, sustained industrial stockpiling with limited substitution options, restricted export flows from key processing regions, derivative market stress that forces cash settlement debates or emergency rule changes, large institutional capital reallocating toward tangible stores of value simultaneously. That is not everyday volatility. That is systemic stress. And systemic stress creates nonlinear pricing. The key word is nonlinear. Markets do not travel from 30 to 1,000 in smooth increments of rational repricing. They gap, they overshoot, they correct violently, they overshoot again. During stress phases, liquidity becomes fragmented. Bid-ask spreads widen dramatically. Futures prices can print levels that do not reflect stable equilibrium, but rather momentary panic, forced covering, or thin order books. A spike to an extreme level does not mean silver is worth that number in steady state. It means the system temporarily lost balance, and balance in silver is easier to disturb than in most asset classes, because the market is small, because leverage is high, because physical buffers are thin relative to paper claims. But here is the counterweight. Extreme upside requires extreme conditions, and extreme conditions often provoke intervention. Exchanges can raise margin requirements. Authorities can encourage cash settlement. Industrial demand can temporarily pause if prices become prohibitive. Substitution research can accelerate. Recycling flows can surge as holders sell into strength. Mines previously uneconomic at lower prices can restart. Supply responds, just not instantly. Therefore, any credible analysis must hold two truths simultaneously. The upside in a structural squeeze can be violent, and the path to that upside is unstable. If silver were ever to approach 3 digits, volatility would likely be historic. If it were to approach 4 digits, it would almost certainly coincide with broader financial turbulence, which raises the deeper question. Is the current global environment trending towards stability or fragmentation? Supply chains are more regionalized than they were a decade ago. Energy transitions require enormous material inputs. Debt levels globally are significantly higher. Monetary policy credibility has been strained repeatedly. Confidence is more fragile. In fragile systems, small disruptions propagate faster. Silver sits at the intersection of industry and money. It is too industrial to be ignored, too monetary to be dismissed, too small to absorb massive capital flows gracefully. That combination is rare. Now let's talk about time. Price shocks do not announce themselves with countdown clocks. They build in silence, then release suddenly. But they can also fizzle if the trigger fails to materialize. It is entirely possible for silver to grind higher steadily without exploding. It is possible for industrial demand to grow while supply adjusts gradually. It is possible for currency systems to wobble, but not fracture. The extreme scenario is conditional, not guaranteed. What makes the present moment different from prior cycles is not social media enthusiasm. It is structural alignment, industrial necessity, geopolitical recalibration, monetary diversification, derivative leverage. When multiple structural forces point in the same direction, probability distributions shift, not certainties, distributions. The tail risk expands. And in markets, expanded tail risk means price ranges widen. Investors who understand this do not fixate on a single number. They focus on asymmetry. If downside is constrained by production economics and persistent industrial baseline demand, while upside includes rare but violent repricing events, the risk-reward profile becomes compelling for some. But conviction without discipline becomes recklessness. Silver has a history of punishing impatience. Sharp rallies are often followed by brutal drawdowns. Weak hands exit at exactly the wrong time. The difference between strategic allocation and emotional chasing determines outcome. So, when people ask whether silver could reach extreme levels within a compressed time frame, the honest answer is this: it could, under stress. It does not need infinite demand. It needs constrained supply, leveraged exposure, and a catalyst that erodes confidence in paper pricing mechanisms. Those ingredients are not imaginary, but they are not fully activated either. We are in the compression phase, the tension phase, the phase where informed participants observe flows rather than headlines. If a shock comes, it will likely feel sudden, it will feel irrational, it will feel exaggerated, and then after the spike, reality will reassert itself in one form or another, either through stabilization at a higher plateau, or through correction back toward equilibrium once stress dissipates. The idea of silver at $1,000 is not a fantasy number pulled from air. It is a representation of what nonlinear repricing can look like in small leveraged markets under systemic strain. Whether that strain reaches critical mass depends on forces still unfolding: currency stability, energy policy, geopolitical fragmentation, industrial demand trajectory, exchange integrity, reserve diversification behavior, all moving parts, all interacting. Silver does not need to reach 4 digits to shock the world. Even a sustained move into high triple digits would rewrite supply contracts, mining economics, and industrial planning globally. It would change behavior, and behavior changes markets. Right now, what matters most is not prediction, it is preparation. Understanding structure, understanding leverage, understanding that calm markets can mask accumulating tension. If tension releases, it will not ask for permission. It will not wait for consensus. It will move. And those who understood the structure before the move will experience it differently than those who dismissed it as noise. Silver has always been volatile, but volatility in a structurally tightening system carries a different character, a sharper edge, a faster pulse, a wider range of possible outcomes. We are not guaranteed a shock, but we are closer to one than we have been in years. And in markets like silver, proximity matters. So here's the bottom line. Silver doesn't need hype. It doesn't need countdown clocks. It doesn't need promises. It needs pressure. And pressure is building in places most people aren't watching. Industrial demand is no longer theoretical. It's structural. Supply growth is not flexible. It's constrained. Paper markets are large, but physical buffers are not infinite. Currency confidence is not collapsing, but it is not unquestioned either. That combination does not guarantee a 4-digit price. But it does widen the range of possible outcomes. And in a small leveraged market, widening ranges matter. If silver were ever to print an extreme number, it would not be because everyone suddenly decided to buy at once. It would be because the system underneath, refining flows, export patterns, derivative leverage, industrial stockpiling, tightened to the point where price had to jump to ration demand. That kind of move would not feel smooth. It would feel shocking, volatile, unstable, and very fast. But here's the part that matters most. You don't prepare for volatility after it begins. You prepare before. Not with blind belief, not with reckless leverage, not with emotional chasing, with understanding, with structure, with awareness of asymmetry. Silver has always been a metal of extremes. It can spend years doing nothing, and then months doing everything. Whether the coming years bring steady appreciation or violent repricing, the era of endless complacency around physical supply looks increasingly fragile. And when complacency breaks, price doesn't whisper, it moves. The question isn't whether silver can shock the market. It's whether the market is ready if it does.